In this step-by-step beginner's guide video, I will explain and show all you need to know about mortgage refinancing. I will also address when it is the right time to refinance your home loan. Refinancing your mortgage means replacing your old loan with a new one. And when you go and shop, you will not find loans with exactly the same term that you have left on your original mortgage. For instance, if you took out 30-year mortgage and 5 years passed, you will not find a 25-year term loan. Instead, you will find 30, 20, 15, and 10-year-old loans. So in other words, lenders will not customize the term of the loan to borrower's needs. The question then becomes which term to choose. Most people will likely choose whatever the term is the closest to their original mortgage. But there could be other considerations at play that may steer you to other options. For instance, your goal for refinancing may be cash out. In that case, a longer-term loan may make sense. For instance, what if you have 24 years and $260,000 in principal left on an original mortgage of $300,000? You can refinance into a 30-year mortgage for $300,000. That way, you pay off $260,000 and keep $40,000 to yourself. Note that it's important that your home value has stayed the same or increased since your purchase. Otherwise, you will have a hard time refinancing at a higher balance. The con of going with longer-term mortgages is that you may end up paying more in interest down the road. We will come back to it shortly with examples. Also, you may choose a shorter duration loan compared to what you have. In that case, you may qualify for a lower interest rate, and also you will be able to pay off your loan earlier. The con of this is, of course, you'll be facing higher monthly payments, and your lender may ask you to show that your income can support these higher payments. And we will come back to shorter duration loans in our examples. Now, let's tackle the costs and benefits of mortgage refinancing. The costs are pre-apparent, which are closing costs. These will be in a similar ballpark as other closing costs you may incur on a typical mortgage. They may range from 2% to 5% and depend on a mortgage company you will work with and your personal situation. Depending on market conditions, you may be able to keep your closing costs under 2%, but it could be hard. Typical closing costs include escrow, appraisal, lending points, insurance, title, and other fees. My personal rule of thumb is to get 3 quotes on major expenditures, be it home repairs, car insurance, or mortgage lenders. And doing so will maximize your chances of getting the best deal on mortgages. And don't forget to go to the same lender. They may be able to work with you and waive certain fees. Maybe they can forgo credit check fee if you have an excellent FICO score. Perhaps they can lower your application fee too. Besides, if you have several quotes, you can spot where you can bargain to lower your costs. Next, what is the benefit of refinancing a mortgage? The most important one is to lower your interest rate and your monthly payments. For that to happen, you must first qualify for a lower interest rate. You may be able to do so if the market rate on mortgages declines for certain reasons. It could be that the Federal Reserve lowered the interest rate, or the markets expect lower growth in economy. In that case, market rates may start going down and you may seize on the moment. Also, you can qualify for a lower rate if your personal situation changed. For instance, if your FICO score went up or you got a new job with a higher salary, banks may be able to offer you a lower rate. We will come back to this in a second with specific examples. Besides qualifying for a lower rate, there could be other reasons why people refinance their mortgages. For instance, what if you want to remove your cosigner for one or another reason? Refinancing a mortgage is the only option in that case. Why lowering interest rate on a mortgage is so important? Well, the answer lies in how mortgages are set up to favor banks. I'm going to use the Bankrate website for this purpose. I'm not affiliated with them, just found their tools super useful. For instance, here's a 30-year mortgage for $300,000 with 7% interest. The monthly mortgage payment stays the same at roughly $2,000 for the entire duration of the mortgage. We see that in 10 years, we would pay almost $196,000 in interest and only roughly $1,000 in principal. In other words, we paid off only 15% of our outstanding principal, but the interest paid in 10 years was over 60% of our home value. That's a shocking result, right? Now, if I lower our interest rate to 5%, the calculus changes substantially. Not only did we pay off more of our principal balance, but the interest payments got from $196 to $137K. Our monthly mortgage payment also got lower by $386 a month, or almost 20%. And by the way, if you want to see the entire payment schedule for a mortgage, they have this tab with more details. Now, let's put everything together and look at specific examples of mortgage refinancing. The goal here is to get benefits that materially exceed our costs. Okay, so let's consider an actual scenario. You have that 30-year mortgage for $300K at 7% interest. That's the prevailing interest rate today. Now, let's suppose 5 years went by. During those years, the interest rate on a typical mortgage could have gone down by 2%. That's a strong signal that there is an opportunity to refinance your mortgage. But there could be other indicators. Let's suppose that during those 5 years, you had a significant improvement in your FICO score. FICO scores range from 0 to 850. According to FINRA, in 2015, improving FICO score from 620 to above 760 results in a 1.5 rate reduction. I will have another video on strategies to improve your FICO score shortly. Stay tuned for that. Another key factor that may decrease your mortgage rate is a so-called loan-to-value ratio. For instance, if you bought a home worth $375K with a mortgage loan of $300K, your loan-to-value is 80%. This is a typical scenario where people put down 20% in down payment. Now, let's suppose that your house value increased to $450K in 5 years. On top of it, you paid off $17.6K in principal according to our mortgage schedule. That means that your loan-to-value ratio went down from 80% to 63%. Material reduction in your loan-to-value ratio can decrease your rate, but by how much? Well, it's hard to say. I tried to search for this information and it's hard to come by. You will probably have to speak to your lender. But I would say that I would start shopping for a mortgage refinancing if my loan-to-value ratio decreased by at least 20 to 30%. And even with that, this may not be enough to materially impact the mortgage rate. Finally, another factor that can lower your mortgage rate is your debt-to-income ratio, calculated by dividing your monthly debt payments by your monthly gross income. For instance, suppose your mortgage payment from before is about $2,000, add a car loan payment of $400 and a student loan of $650. If you have other periodic payments such as personal loans or credit card debt, include them too. With this, our total monthly debt payment came out as $3,046. Suppose that your monthly gross salary before taxes and other deductions is $8,500. Then your debt-to-income ratio is about 36%. Most lenders prefer a debt-to-income ratio of 36%. There could be cases when someone started with a 43% or even higher, which is less typical. So let's suppose you started with a 36% debt-to-income ratio. Well, in that case, there's probably a lower chance that you will be able to get a material reduction in your mortgage rate. But if you started with a debt-to-income ratio above 36% and you were able to lower it, there is some potential there. Again, by how much, it's hard to say. I tried to search for this information, it's hard to come by. You will have to check with your lender. With that said, let's suppose that you managed to get pre-approved for a 30-year mortgage at 5% for $282K. $282,000 is roughly your remaining principal after 5 years of payments. You went with a lender that offered you not only the best mortgage rate, but also the lowest closing cost of 2%. Now let's head to a mortgage refinancing calculator. Here, let's enter our inputs. We enter our remaining balance, all the new rates, monthly payment, and remaining remaining term. Here you will need to choose the term for a new mortgage. As I mentioned before, it could be either 30, 20, 15 or 10 years. Let's roll with 30 years for now. Next are closing costs. Here you see breakdown by each line item. I won't enter individual amounts. Rather, I assume that you got 2% closing cost or $5.6 thousand on your remaining balance of $282K. I will enter it just here in the other category. After hitting the calculate button, here's what we see. Your monthly payments went down to almost $1,500 or by about $480. But remember, we had to pay $5.6K in closing costs to get this monthly savings. So it will take us about 12 months or $5.6K divided by $480 to recoup this upfront cost. In other words, you will need to live in the same house for at least a year to break even. Only after that you will start accumulating savings on mortgage refinancing. If you ask around, most people say that their max wait is about 18 to 24 months. But it doesn't have to be so. It depends on your situation and how long you expect to live at your property. Of course, the lower the interest rate is on a new mortgage, the faster you will recoup your costs. With 4%, it goes down to roughly 9 months. Another strategy can be to choose a lower term. So instead of picking 30 years, you can choose 20 years. In that case, your monthly payment would not go down by as much. It would be about $1,900 and you would need to wait over 3.5 years to break even. But by refinancing into a lower term, you cut your cumulative interest payments over the life of a loan big time. For instance, with a 30-year loan at 5% for $282K balance, you get to pay about $263K in cumulative interest to the bank. With a 20-year loan, you get to pay only $165K. That's almost $100,000 difference. So, should you refinance into a 20 or a 30-year term? Well, the answer depends on your goals. If your goal is to ease financial burden and minimize your monthly payments, then of course going for a higher term like 30-year mortgage is a better choice. But what if you're okay with paying the same or maybe higher monthly payments and you want to save on cumulative interest that you paid to the banks? Then of course going for a lower term like a 20-year term in our example is a better choice. You will pay approximately in our example $5.6 thousand in upfront closing costs to get a savings in interest of almost $100,000. That is a material payoff. One thing I want to note about this calculator is that it ignores the time value of money. What do I mean by that? The thing is that by paying closing cost of $5.6K, you are foregoing interest that you could have earned on it. The current short-term treasury rate stands at about 4%. So each year you wait to recoup your upfront closing cost, you should add interest to it. In our case, it's $220 in the first year. After that, it compounds at 4%. So for a 4-year wait, 5.6 compounds into 6.5K. Of course, I assume here that 4% stays the same, but it may not. But other than this mortgage refinancing calculator is a handy tool to assess whether mortgage refinancing makes sense or not. On a final note, I want to mention that it is possible to refinance your mortgage and not pay your closing cost. This is a so-called no closing cost refinance. And it's not like you don't pay those closing costs. They actually folded into your new mortgage. So you take out, in essence, like a loan on them. The lender may demand a slightly higher interest rate due to this. But if your overall reduction in mortgage rate is large enough, it may not even matter. So under what circumstances this no closing cost refinance makes sense? I would say it makes sense for someone who is struggling to make monthly payments and is low on cash. If the mortgage rate reduction is material, it can help them a lot. And that is it for this video. I hope you found it helpful. Please support my work by giving this video a like and subscribe to my channel for more useful personal finance videos. Also, share this video if you think it can help someone. As always, thank you so much for watching and I will see you next time. All the best!